Hello guys and welcome back to another class of our course about the complete introduction to Forex trading. So in today's class we are still talking about fundamental analysis, and we are gonna see what are the most important indicators, what are the important indicators for fundamental analysis or to complete a good fundamental analysis. So let's start. So first of all, as I said, the fundamental analysis is all about macroeconomics. So the first indicator that is very important, not only for me but for everyone, is the GDP, or the gross domestic product. It's simply a monetary value of all finished goods and services made within a country during a specific period. What does this mean? It means let's say, imagine the US, and all the products that are that are made in US are counted in the GDP. Also, the GDP can be for the whole country, but can also be per citizen. So let's say for each person that is living in the US, the GDP will be somewhere around, if I'm not mistaken, something like $50,000 or $60,000, which is per citizen, and you have the GDP for the whole country. The GDP is a huge indicator for fundamental analysis, because if it goes up, this means the economy of the country is strong, and it means that the currency of the country will also be strong and will become stronger. In the other case, if for example the GDP goes down, it means simply that the economy of the country is not that strong, and the value of the currency will simply go down as well. Also, the GDP, as I said, it can be calculated two times in two ways, for the whole country, but also per citizen. Let's say, for example, if we take the US, yes, the GDP for the country will be huge, but the GDP for a citizen will also be huge. If we compare it to the GDP of India, you'll see that the GDP of India is almost as huge as the GDP for the country is very huge, close to the US one, but the GDP per citizen is way much lower. So this is for the GDP. As I said, it's one of the most important indicators that exists. The next one will be the interest rate of central banks. What is the interest rate of the interest rate of central banks? Very simple. It's the interest rate that the central bank will use to lend money to other banks. So this interest rate will define how much will be the interest rate in the country. Let's say that smaller banks will lend money to normal users. So let's say, for example, the interest rate of central banks is 2%. This means they will lend money to other banks for a interest rate of 2%, and those banks will lend this money to normal users or to other people for more than 2%. So everybody will make a certain profit. How this can have an effect on our currency? Well, it's very simple. Let's say, for example, that the interest rate goes up. This means that the currency is stronger because you have less people that borrow, and people will invest more in the bond market, because the interest rate of the central bank will have an effect on the interest rate that is on bond market. And this means that people will invest more in the bond market. This means that the economy or the country will become way much stronger because people are investing in the bond market of this country. On the other hand, if for example the interest rate goes low or becomes lower, normally and theoretically this means that the value of the currency will decrease, because people will take their money out, will use more money. There will be more money that will be used, and this money usually goes and is invested on the stock market because it's more risky. So people don't want to keep money in banks, don't want to invest in bonds. They take money out. This is why the value of the currency normally goes down. Well, a bit lower, will go lower, but normally, theoretically, it's not always happening, but in the majority of times, this is why. Next thing, the unemployment rate. So what is the unemployment rate? It's simply the number of unemployed people. Put it in a percentage in a certain country. So usually, normally in the US, the unemployment rate is something between 5 and 9%. something like this. Sometimes it's a bit lower, sometimes it's a bit higher. But normally it's something around, as I said, 5 and 9, so it's something between like 7-6%. Once again, this has a huge effect on the value of a currency, because the people who are working are the people who are making the economy run, and without those, and if there is too much people who are not working, this has a direct effect on the currency of a certain country, because it brings out other questions. People who want to buy this currency will ask themselves, is this country secure? Is this a recession that is preparing, or like other questions, and this will make the currency go down. So this is why the unemployment rate is a huge factor and a huge indicator for fundamental analysis. Once again, it's as I said, it's the people who are not working, put it in percentage, and when the unemployment rate goes down, so for example there is less people who are not working, so more people are working, that's a good thing. And if the employment rate goes up, well, that means that the economy is going a bit more badly, and this means that the value of the currency will also go down. Next thing will be the inflation rate. Every year you have a certain increase in prices, a certain increase in everything, and this is all because of the inflation rate. So if we talk from, the definition of this in a theoretical way will be simply a sustained increase in the general price level of goods and the services in an economy. So let's say, for example, that the inflation rate of a certain country is 2%. This means that the value of all the products in this country will increase by about 2%. Yes, in certain industries it's gonna be more. In other industries it will maybe not increase at all. But once again, it's just the average of all increases that will give you the inflation rate. So as I said, let's take the example of that country that has an inflation rate of 2%. Maybe the value of, let's say, meat will increase by 4%, but the value of, let's say, vegetables will not increase at all. But once again, it's just an example. So as you can see, the inflation rate is simply by how much the value of a certain product or of all products in this country will increase year by year, and it also will lower the power of the buying power, the purchase power, the buying power of people who owns the money. So let's say you have 1 million today. Well, this $1 million will not worth $1 million in 1 year. In 1 year, this $1 million will maybe be worth, let's say, $900,090. And once again, it all depends of the inflation rate in the country. So your buying power will decrease over the years because of the inflation rate. So those are the 4 major indicators, fundamental indicators. But as I said on the last one previous course, there are other important political and economical news that can affect our fundamental analysis. As I said, for example, let's say the president of the US right now decides to make a tweet. Well, this will definitely affect the US currency, maybe in a good way or maybe in a bad way. Let's say, for example, there is a war or something somewhere. This will directly affect the currency. Let's say, for example, something happens. Let's say the oil industry, for example, right now it has a problem. This also has an effect on the currency. So there is a lot of factors that can affect the value of the currency of a certain country. Once again, those are the 4 main indicators for to make a good fundamental analysis and to have a good idea of if the currency will go up or will go down. So that's it for this class, guys, and see you all in our next class, where we are gonna talk about the places where you can find information about all those about all this fundamental data.